Hello everyone, Amit Parak here from FinstudyClub. Here I am with another QuickPrep session, and this is on portfolio management. As a section, portfolio management is extremely interesting and very rewarding. So there we go. We're going to discuss portfolio risk and return. And within this, let's start off with the concept of holding period return. How would I compute holding period return? So let's say if I would have held on to my investment for time t, having bought the asset at P0 and finally selling it at PT, or this is the price at the end of time t, and this is the dividend that I've earned, then what is going to be my return over this period? Well, my return is going to be PT minus P0 plus DT divided by P0. I can further break it up into PT minus P0 by P0 plus DT by P0. Well, this is your capital gain. I bought it at P0 only to sell it at PT. Well, this is my capital gain or capital appreciation. This portion is my dividend yield. So we realize that my holding period return is going to be made up of two components, capital gain and dividend yield. Now, how would I calculate the holding period return, which is spread for more than one period? Well, I'm going to calculate, let's say if I have a 3-period holding period, so this is period 1, 2, 3, and I've been holding on to an investment for 3 periods. Well, the way I would calculate my holding period return is first to calculate the sub-period return. Let's call them R1, R2, R3. How would I calculate R1, R2, R3? Well, exactly this is the way I would do it. So my R1 is going to be P1 minus P0 plus D1 divided by P0. So that would give me R1. My R2 is going to be P2 minus P1 plus D2 divided by P1. So you calculate R1, R2, R3, and then you find out the cumulative compounded return, which is 1 plus R1 into 1 plus R2 into 1 plus R3 minus 1. So this as well can be extended to n periods as well. How do I calculate the geometric mean return of an investment which has been spread over multiple periods? Well, I'm going to take the product of 1 plus R1, 1 plus R2, 1 plus R3. So let's say we extend our example, 3-period investment. I want to calculate geometric mean return. I'm going to take the cube root of this and reduce 1 from it. What's going to be the arithmetic mean? R1 plus R2 plus R3 divided by 3. Which is going to be greater, arithmetic mean or geometric mean? Well, it's arithmetic mean, which is going to be greater than geometric mean. And the difference between the two is going to be the function of the volatility of return. So greater the volatility of return, greater shall be the difference between the AM and the GM. How do I calculate the effective annual return if I've been given the periodic return? So let's say if I've been given the 6-month return to be 4%, and I want to calculate the effective annual return. Well, it's going to be 1.04 to the power 2 minus 1. And the reason is very simple. For a 6-month period, I earn a return of 4%. There are 2 6-month periods in a year. So I might as well extend the 4% return and then argue that over a period, this 4% will get compounded twice. And hence, this is going to be my effective return. If my return is being suggested as a quarterly return, and let's say it's 1%, okay, how would I calculate the effective annual return? Well, a year would consist of 4 quarters, and hence it's going to be 1.01 raised to the power 4 minus 1. Pretty much easy to understand. So if I've been given the monthly return, let's call it RM, then 1 plus RM to the power 12 minus 1, because a year consists of 12 months. Alright, so let's now look at portfolio. We all understand that a portfolio is basket of assets. So let's say you have 2 assets, with asset 1 giving you a return of R1, asset 2 giving you a return of R2, and with the weight on asset 1 being W1 and on 2 is W2. How do I get the weights? Well, I look at the current value of the asset. So let's say the current value of asset 1 is 200 and that of asset 2 is 300. Then the W1 value is 40%, which is 200 by 500, and W2 is 60%. And I can easily calculate the mean return, the portfolio return. It's going to be 40% of R1 plus 60% of R2. Now coming over to the variance of single asset, we are trying to calculate the risk which is there in this asset. If I were to invest into this asset, how do I gauge the risk? Well, one measure is the variance of return. And how do I compute it? Well, I'm going to look at the past data. Let's say If I have the last 10 years return, annual return, I look at it. So let's call it R1, R2 and so on till R10. I'm going to take all the R values, but of course, after reducing the mean from it, and I'm going to take the square of it and then the summation of it and divide it by T. This gives me the variance. So you're going to take R1 minus mu, R2 minus mu, and so on. Take the square of this, add it up, and once you've added, divide it by 10, and then take the square root of it. That's going to give you the sigma. Instead of mu, if I try and place the mean return, which is being calculated based on the sample, then I will make sure that I divide it not by t, but with t minus 1. Because remember, if you use the sample mean to calculate the variance, well, you're going to divide it not by n, but n minus 1. In this case, t minus 1. Next, how do we calculate the variance for a portfolio? So let's continue with our example. So we had R1, R2 with the weights being W1, W2. And let's say the sigma of asset 1 is, and sigma of asset 2 is sigma 2. And I need to calculate the sigma of the portfolio. First, we'll try to calculate the variance. The variance of the portfolio is going to be W1 squared sigma 1 squared, W2 squared sigma 2 squared, plus 2W1 W2 sigma 1 sigma 2 rho, which is correlation between 1 and 2. And remember guys, sigma 1 sigma 2 into correlation 1 2 as well can be replaced with covariance between asset 1 return and asset 2's return. Okay, so that's how you would calculate the variance of a portfolio. This expression looks very similar to a square b square 2ab. A square b square, and this is 2ab, or just a bit of deviation. You will bring in the rho factor as well. So you realize that if the correlation is 1, this value is going to be extremely high. There is hardly going to be any diversification benefit. If the rho turns out to be minus 1, that is where you can bring it down, because that's where your diversification benefit is going to be the maximum. So the variance of the portfolio is going to be determined not only by the individual variances of the components, but also the kind of correlation that exists between the returns of the two assets. Let's now look at utility function. Now we all understand that we love any investment because of its return, but then there is another aspect to it, which is risk. So you would say, hey, I love return, but do I love or hate risk? Well, it depends upon what kind of an investor are you. So if you are an investor who is risk averse, you are going to hate risk. If you are a risk neutral investor, you are indifferent to risk. And if you are a risk seeking investor, you love risk. Okay. So the utility that we would associate with any investment is definitely going to be a positive function of expected return. Higher the return that you expect from an investment, greater the utility that you would associate with that investment. But at the same time, what about risk? Well, if I am a risk-averse investor, and that's normally the assumption that we carry in most of the theories that we discuss, then I am going to dislike risk. So I'm going to have a negative sign to the risk factor. So minus half times A times the variance of return. And this is essentially what risk stands for, your variance of return. Now you realize that you have a value A. So A sort of defines the degree to which you are averse to risk. So the greater the value of A, the more averse you are to risk. I also realize that if A is 0, then essentially the second term becomes 0. So that essentially would mean that I'm a risk neutral investor. If A is greater than 0, we are talking about a risk averse investor. And if A is less than 0, when A is less than 0, it becomes negative. As a result, this term would become positive. That means utility becomes a positive function of risk and return. Then we know that we are talking about a risk-seeking investor. Okay, so we come over to portfolio risk and return part 2. So few concepts that you need to be familiar with. One is capital allocation line, the other is capital market line. You need to know the efficient frontier and then the security market line. So here we have the axis return on the y-axis, risk on the x-axis, and to begin with, my risk is measured by the sigma of return. This is what would be your efficient frontier. So this clearly is the frontier of all those portfolios which are efficient. You don't have portfolios better than these set of portfolios. Now I also realize that I have the risk-free asset and it can be combined, and let's call these portfolios A, B, C, D. I can combine RF with A to get this line, and this line represents all those portfolios which can be created by combining RF and A. I'm going to call it CAL1. This is capital allocation line. I can also have another capital allocation line which is going to look like this, another capital allocation line which is going to look like this, and I realize that capital allocation line 3 possibly is the best line that I can come up with. It's a tangent to the frontier. It's the capital allocation line with the highest slope, and slope out here would represent the excess return over every unit of risk that you take, isn't it? So I know that I would essentially focus on that CAL which has the highest slope, because that represents the greatest extra return that I can get for every unit of risk that I take. So the best CAL would be termed as CML. So what is going to be the equation of the CML? So let me represent how your CML is going to look like. It's a tangent to this efficient frontier. So every investor would find himself or herself investing in one of these portfolios, because this clearly is the best set of portfolios, and all these portfolios are essentially the combination of this portfolio, the risky portfolio, we'll call it the market portfolio, and the risk-free portfolio. So what's going to be the equation of this line? The equation of this line is going to be based on the format y is equal to mx plus c. My y over here is the return of any portfolio which lies on this line. Let's take this portfolio and let's call it P. So the return of P is going to be equal to C plus Mx, where C is the y-intercept, which is RF, plus Mx, where M is the slope. How do I get the slope? Well, let's consider these 2 points. So you have Rm, so Rm minus Rf divided by sigma M minus 0 into X, where X value for this variable point P is sigma P. So this is going to be the equation of CML, and this slope is termed as the market price of risk. Now remember, when we look at sigma, which captures the risk of the investment, well, that's the total risk, and your total risk would consist of systematic risk and unsystematic risk. How do I arrive at the return model? Well, your return model could be a single factor model, so something like CAPM, which we would see going forward. So it's like Ri is equal to Rf plus beta into Rm minus Rf. Or I could actually take some other return generating model, which could be a multi-factor model. So there essentially we are talking about Ri being equal to Rf plus beta 1 factor 1 plus beta 2 factor 2 and so on till beta n factor n. Okay, so you're going to have n factor kind of a model. Of course, your CAPM becomes a simple version of it, where you have a single factor, and this single factor is the market risk premium. How do I compute beta? Well, beta is the measure of systematic risk, and the way we would compute is, so if I want to find out the beta of security I, I'm going to look at the covariance of the security return with the market return divided by the variance of market return. So that's how I would calculate the beta. There we have the CAPM. So remember guys, we've already talked about the capital market line. Now I realize that the individual securities don't lie on this line. So this is the capital market line, and this is what we got from the efficient frontier, but the individual assets were lying somewhere over here. Now how do I justify the existence of this asset at this level? Because it gives you a return which is over here, but it has a risk which is somewhere over here. So why would somebody invest into this security when they can easily invest over here or here, right? So I can invest here, I can take as much risk but invest into a better asset rather than the security. But this security seems to exist over here, so it's a fact which you cannot deny. Well, do remember what we've plotted on the x-axis is the total risk, but then it's not the total risk of the security which is going to be relevant to me, it's the systematic risk. So when I start plotting the systematic risk as captured by beta, and I have return on the y-axis, well, all the securities that exist would start getting plotted on this line, and this line would be termed as a security market line. So remember guys, the comparison between CML and SML. In the case of SML, the risk that you are plotting is getting captured by beta, and the risk that you are plotting is the systematic risk. And all the securities would ideally lie on the SML. So if you have a security above SML, well, that's a security which is worth buying. It's underpriced because for a given level of risk, it seems to give you much better return than what SML indicates. So it's underpriced. You go out and buy it. If you have a security lying below the line, below the SML, it's overpriced. And one which is lying on the SML, that's fairly priced. How do I set up the equation of the SML? Well, pretty simple. There are two reference points that I'm going to look at. One is this, and let's say there is this another point which is over here. So this point is your RF, and this point represents the market. The beta of market is 1, okay, because we compute beta as covariance. So beta I is covariance of I with M divided by variance of M. So when I replace I with M, so beta of M becomes covariance of M with M divided by the variance of M, which is variance of M by variance of M, which is 1. So how do I set up the equation of this line? Well, it's going to be Ri is equal to Rf plus, what's the x value? Beta I into the slope. The slope is going to be Rm minus Rf divided by 1 minus 0, which is essentially Rm minus Rf. Now that's your CAPM, capital asset pricing model. Now we move on and look at some of return measures, the portfolio return measures, extremely important for the exam guys. Sharpe ratio, Rp minus Rf by sigma of P. So here we are trying to calculate the risk return measure where the risk that we are taking is the total risk. Okay, so that's Sharpe ratio for you. The higher it is, the better it is. Then you have the Trenner ratio. Instead of taking the total risk measure on the denominator, I shall take the systematic risk measure, which is beta. So Rp minus Rf by beta of P gives you the Trenner ratio. The higher it is, the better it is. Then we move on to M-squared. The M-squared expression is slightly more complex. So let me just discuss it in a while. Coming over to Jensen's alpha, well, we see that some of the securities, if they are able to generate return better than what is expected of them, going by the CAPM model, the extra return that they give would be known as alpha. So I look at the return of the portfolio minus return of the portfolio as it should be going by the CAPM model, which is RF plus beta P into RM minus RF. So RP minus this sort of a risk adjusted return gives you the abnormal return. So as an investor, I would love positive alpha, isn't it? So if you have an underpriced security, I expect it to deliver positive alpha. If you have an overpriced security, I expect it to deliver a negative alpha. Now moving over to M-squared, let's discuss this very quickly. All right, so let me now try and explain you the concept of M-squared, which again is taken as a performance measure for a portfolio. So let's say this is where my RF lies, this is where you have the market portfolio, and hence this is where your market return is, and this is where your risk of the market is. Now I have another portfolio, and let's call it P, and P seems to be somewhere over here. So this is where it is. So in terms of return, this is what P has given, much better than the market. But then in terms of risk, the risk of P as well is more than that of the market. So has P done better than the market? How do I compare my portfolio's performance vis-a-vis the market? Is it an outperformer or an underperformer, or has it done only as well as the market? Well, that's what we try to gauge by M-squared. Look at this. This is CML, capital market line. Let me try and create another line which combines RF with portfolio P. Now I'm going to compare CML with this particular line. And this distance, mind it guys, this distance is what we try to compute by way of M-squared. So if you intuitively try and understand, we are trying to look at a comparable portfolio on this line and see how it compares with portfolio M. This is the extra return that it seems to give. This line seems to be better than CML, and the gap between the two is what gets captured by M-squared. and we try to measure this vertical distance at sigma m. So how do I compute m square? Pretty easy. Now look at this portfolio P. Well, the extra return that it gives over and above the risk-free return is Rp minus Rf. Well, look at M. The extra return that market portfolio gives over the risk-free return is Rm minus Rf. But are the two extra returns comparable? The answer is no, because P has greater risk as well. So I'm going to divide it by the risk of P and multiply it with the risk of M to get the excess return which is comparable with the excess return which the market portfolio gives. And then take the difference between the two, Rp minus Rf by sigma P into sigma M minus Rm minus Rf. This gives me M square. So this is another performance measure that we should look at, and you see that here the risk that is being taken into account is the systematic risk. There we come to the end of this session. I hope it turns out to be useful for all of you. Good luck.